Mr. Afero, salam alaikum. Can you hear can you hear me?
Hi, Walaikum Salam. Can you hear me?
Good, yes, I can.
Alhamdulillah. How are
Great.
you?
Our pleasure to have you. I'm good, thank you. How are you?
Good,
How are you, sir?
Good
All
to
is
know
good.
that.
Alhamdulillah. We'll be starting shortly. So,
Okay, sure.
hold on,
No.
please. Thank you. Ladies and gentlemen, distinguished participants, dear colleagues, Assalamu alaikum wa rahmatullahi wa barakatuh. Before we start today's public hearing session, allow us to present a short video highlighting one of the supporting partners of this session, Brunei Institute of Leadership and Islamic Finance. Is the video ready? Okay, good. Actually, we are sorry, there is a technical glitch. Sound is not operative. Apologies for that. We would try again later in the session to run the same material, inshallah, after fixing the technical glitch. I think now we can just move on. We will we'll come back to that to the same material later in the session. Can we stop it and try to fix it, and then later in today's session, inshallah, we will present the same footage. Apologies for that, for the unintended technical glitch. Okay, Mr. Afero, can you hear us?
Yeah.
Okay, good.
Can you hear me, by the way, Mr. Majid?
We can, yes. Thank you very much for being around. Ladies and gentlemen, distinguished participants, dear colleagues and experts, Assalamu alaikum wa rahmatullahi wa barakatuh. It
Salam.
gives us great pleasure and honor to welcome all of you to this public hearing event, constituting an advanced interaction stage with the Islamic finance industry and the broader circles of stakeholders worldwide, and being the third leg in a series of public hearings for the newly issued exposure drafts entitled Deferred Delivery Sales and Istisna-based development contracts, both representing the output of the review project for existing financial accounting standards, FAS 7 and Salam and Parallel, titled Salam and Parallel Salam, and FAS 10, entitled Istisna and Parallel Istisna, with a particular aim to reach out to subject matter experts and practitioners and other stakeholders worldwide, where their comments and views can be raised, discussed, and then compiled and submitted to the respective working group for its consideration and submission to the AAOIFI Accounting Board for its final review and approval for issuance as a final standard. The first exposure draft prescribes the accounting and financial reporting principles for recognition, measurement, presentation, disclosures, related to deferred delivery sales transactions applicable to the buyers and sellers for such transactions, which include both Salam and Istisna-based deferred delivery sales transactions. But the first exposure draft do not include Istisna-based development contracts, which are subject to the second or the subject of the second substandard being simultaneously issued, which in turn prescribes the accounting and financial reporting principles for recognition, measurement, presentation, and disclosures related to Istisna-based development contracts, which are generally medium to long-term in nature, as applicable to the developers and the customers for such contracts. The public hearing today is conducted via video conferencing, and participants join us from different time zones worldwide. So we'd like to welcome all of you again, and we really appreciate you taking the efforts to join us today. Today's session is being conducted with support from BILIF, Brunei Institute of Leadership and Islamic Finance in Brunei, represented by Mr. Aero Iswandi Muhammad, Acting CEO. It's also being held in collaboration with UAE Banks Federation, UBF, and Bahrain Association of Banks, BAB. We would like to record our appreciation for all of them for taking an active part in today's session. Before we start the session, let me give the mic to Mr. Aero Iswandi, who will be providing a short introductory remarks for this session. Mr. Aero, the mic is yours.
Okay, thank you, Mr. Majid. Alhamdulillah. Bismillahirrahmanirrahim. Alhamdulillahi Rabbil Alameen. Wassalatu wassalamu ala ashrafil anbiya wal mursalin Sayyidina Muhammad wa ala alihi wa sahbihi ajma'in. Mr. Omar Mustafa Ansari, Secretary General of Accounting and Auditing Organization for Islamic Financial Institutions, AAOIFI. Distinguished participants, esteemed speakers, ladies and gentlemen, Assalamu alaikum wa rahmatullahi wa barakatuh. And a very good morning if you are in the Middle East, and a very good afternoon to those from the Southeast Asia. On behalf of the Brunei Institute of Leadership and Islamic Finance, BILIF, it is my great pleasure and honor to welcome you to today's joint public hearing on the exposure drafts issued by the Accounting and Auditing Organization for Islamic Financial Institutions, AAOIFI. We are truly humbled to be a part of this important event held, as mentioned earlier, in collaboration with AAOIFI in partnership with the UAE Banks Federation, UBF, Bahrain Association of Banks, BAB, and of course, BILIF. Very heartfelt thank you to AAOIFI for inviting us to support this initiative and to be a part of this global platform that encourages open dialogue and shared progress in Islamic finance. And As we all know that today's public hearing focuses on two key areas, which is the deferred delivery sales and Istisna-based development contracts. This is a very valuable opportunity for all of us, whether you are the practitioners, academics, policymakers, or regulator, to share your thoughts, raise questions, and offer any suggestions. Your input will obviously help shape the final standards and ensure they reflect the diverse perspectives and needs of our industry. By the way, for those who may be new to BILIF, we are the Center of Excellence for the Finance Industry in Brunei Darussalam, operating under the purview of Brunei Darussalam Central Bank. And of course, our mission is to build capacity and to promote thought leadership in Islamic finance and leadership development. Over the years, we have committed to deliver relevant knowledge, foster collaborations, and support the growth of Islamic finance both regionally and globally. Our partnership with AAOIFI is a reflection of this commitment. And of course, we've proudly offered several of AAOIFI's flagship programs in Brunei. That includes the Certified Sharia Auditor, CSA, Certified Sharia Expert, CSE, and the Certificate of Proficiency in Sharia Standards, CPSS. And these programs have obviously helped the professionals in Brunei and the region to align with globally recognized standards. In 2022, BILIF and AAOIFI have co-hosted the Sharia Advisory Conference supported by the Brunei Darussalam Central Bank and in association with Bahrain Institute of Banking and Finance, BIBF, as well as the Cambridge International Finance Advisory. It was a hybrid event that brought together Sharia experts, regulators, scholars, and practitioners to exchange ideas and best practices, further positioning Brunei as the growing hub for Islamic finance knowledge. And in that same year, we also signed a Memorandum of Understanding, MOU, with AAOIFI to deepen our collaboration in training, research, and thought leadership. And today's hearing, it marks another meaningful step in that journey. We truly appreciate AAOIFI leadership in setting global benchmark for Islamic finance. It's through inclusive and open discussion like this that we can continue to strengthen the foundations of our industry. So I encourage everyone here to actively participate in this discussion, where every voice matters. The strength of the standard lies in the diversity of perspectives behind it. Once again, thank you to AAOIFI for this opportunity. We look forward to the insightful discussions, and thank you all for your time, interest, and contribution to the development of our Islamic finance standards. Wabillahi taufiq daya. Assalamualaikum warahmatullahi wabarakatuh.
Alaikum salam
Back
wa
to you.
barakatuh.
Yeah.
Thank you very much, Mr. Aero Iswandi Muhammad, Acting CEO, Brunei Institute of Leadership and Islamic Finance. Thank you very much for the insightful introduction.
Thank you.
I think our technical team has solved the issue. So dear team, let's present the short video again, which will highlight the efforts extended by Brunei Institute of Leadership and Islamic Finance on multiple fronts, including the training extension, relationship with AAOIFI, as Mr. Afero highlighted earlier in the session, among others. Please, if the video is ready, let us run the video. As I understood from my colleagues, the glitch has been fixed, and inshallah, they are ready to run the video. Can we run it now? And again, sorry for the unintended, error, the glitch that happened at the beginning of the session. Our apologies for that. In the meantime, we will be, inshallah, starting the session discussions in a matter of maybe 5 minutes after we present the material, inshallah. Okay, ladies and gentlemen, again, dear brothers and sisters, I feel that the issue is still there, so we can start the session. And in the meantime, our team will be fixing the issue, and we will get back to that, inshallah, during the session. Thank you very much for holding on. It is now let me introduce to the floor. I'm pleased to invite to the virtual floor Mr. Omar Mustafa Ansari, AAOIFI Secretary General, to present the exposure draft and walk you through the main content while interactively answering your questions and addressing your comments. As I mentioned earlier, all relevant comments and suggestions will be collected and presented to the respective working group for its consideration and to make the changes it deems appropriate to the exposure draft before submission and after completion of all the legs of public hearings to AAOIFI Accounting Board for its further review and issuance of the final standards. Now, I'm handing over the floor to Mr. Ansari. Brother Omar, over to you.
Thank you very much, Brother Majd, and thank you very much, Brother Aero Iswandi and the management of BILIF and other partners who have joined in today as well. أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Ladies and gentlemen, Assalamu alaikum wa rahmatullahi wa barakatuhu, and very good morning and good afternoon and maybe even good evening for some of the participants. Thank you very much, everybody, for joining in. Thanks for the sponsors and the partners for this public hearing for supporting it. I think that this is, if not mistaken, this is the last public hearing in English, but there is one public hearing in Arabic that will be conducted after that. Brother Majd, just correct me if I'm not wrong. I think this is the third and last public hearing in English language, but there is one pending in Arabic.
Yes, it is the third, brother.
When the Arabic one is planned? When the Arabic one is planned?
This month, inshallah. This month, later in the
month. This month, inshallah, within July, inshallah. Because the plan is that we want to finalize this standard within this year. So probably in the upcoming meeting of the board by end of July or beginning of August, we will be taking this one to the board, inshallah. A little bit on the introduction, although Brother Majd has already mentioned, but let me just try to summarize a few quick points before I can open up the presentation and move ahead. So first thing is that AAOIFI has initiated this project of revising these standards as a part of very comprehensive project that we started in 2017-2018 that was on revision of all the existing financial accounting standards of AAOIFI. The revision was to address, number one, the market challenges. We conducted surveys and roundtables to identify what are the challenges and issues the market is feeling. The second challenge was to align the things with the newer international financial reporting standards and other generally accepted accounting principles as maximum as possible. So, for example, IFRS 15 had come up and IAS 11 was no more there, and the 5-step revenue recognition model was introduced. This 5-step model was also accepted by from Sharia perspective and also accepted in AAOIFI's framework and financial accounting standard number 1. So the third objective was to remove any anomalies between the framework and the new framework and new phase 1 with the existing standard number 7 and 10 on Salam and Istisna. Salam and Istisna are two of very important products of Islamic finance. In some of the markets, they are actually playing a very important role in Islamic finance growth, particularly in agri sector, in export and manufacturing sectors, etc. Not only this, in some of the areas, it has been a huge focus Although there are some challenges because of the fixed pricing of Istisna, but still there have been a huge sort of utilization of Istisna, or possibility, even more bigger possibility of utilization of Istisna for the infrastructure projects. Putting it all together, I would say that the unique form of deferred delivery sales, where payment is done in advance and the assets are delivered or a commodity is delivered at a later stage, in contrast to our normal deferred payment sales transactions like Murabha, where we have goods are purchased and sold and then recovery is made. So these products have an equally important potential, particularly for some of the sectors, to find out the real solutions within the Sharia parameters without resorting to any of the, sorry to say, controversial products of Islamic finance, and particularly where the seller needs cash financing. Salam and Istisna are actually good means of cash financing, because in Murabha, you don't do cash financing. I'm talking about Murabha, I'm not talking about Tawarruk. And again, you all understand that normally AAOIFI's view about Tawarruk is that it should be used only on need basis. It's a product that has its own negatives, and it should not be used as a common product of investment and financing. And this is, I'm not saying from myself, it is what is written in Sharia Standard number 30 on Tawarruk. So for the cash financing, the real solutions that are available include very good options of Salam and Istisna that can be utilized. Now, why we are revising the standards? Okay, first thing, what we are changing. I think first thing, as I said, we are aligning with newer IFRSs as much as possible. Number two, we are aligning with the new AAOIFI FAS, etc. Number three, we are trying to fill in the gaps. There were some gaps as well. So for example, the asset was, like for example, Salam standard covered Salam transaction and parallel Salam transaction, while the practical use of parallel Salam transactions is very minimal. That more common use of Salam transactions is Salam with agency. That probably was not covered exactly in the same way. Similarly, if you see that the counterparty accounting, that is, if I'm the Salam seller, my accounting is covered in current FAS 7. But what happens if I am a purchaser of Salam assets or Salam commodity or Istisna, same way? So this is where we had these challenges on the Salam side. The third, another important thing is that when we initially developed those standards, at that point of time, AAOIFI was not having separate Sharia standards. So most of the Sharia conditions were included in AAOIFI's initial standards as body text of the standard, as well as in the appendix. Now, once AAOIFI started developing Sharia standards, it was decided that all AAOIFI accounting standards are to be read in conjunction with and within the interpretations and definitions provided by the respective Sharia standard, which means that duplicating or replicating the Sharia requirements in the accounting standards would no more be appropriate, particularly considering that while we have a mechanism of review by the Sharia committee, but it is done by the accounting board, not by the Sharia board. So the better approach that has been devised several years back by AAOIFI, that all accounting standards are to be read with the respective Sharia standard, but not to contain Sharia requirements by themselves. Rather, they have to define how respective Sharia requirements or how respective Sharia compliant contractual arrangements are to be interpreted for accounting purposes and how they are to be applied in reality. So from that perspective, in the newer standards, we decided that we will avoid duplication and replication from the Sharia side, particularly also because there might be at times a little bit of interpretation issues or a little bit of contradiction is also possible. Although we didn't identify any significant contradiction, but there is a possibility. So from putting all those perspectives, it was decided to keep it focused on accounting only and leaving the Sharia side with a reference to the respective Sharia standards. Okay, there were some additional practical issues that I will come later on, but this was the main basis on which we initiated several years back this revision project. We evaluated the current standards We identified the current standards and then found how we can do it. One thing I would like to mention, in clarity, that the principal accounting treatment, the principal approach with regard to deferred delivery sales, including Salam and Istisna, and the principal fundamental guidance of Islamic finance accounting with regard to control and transfer of asset and ownership, etc. All these things are not changed. They are clarified. They are better worded. They are explained in a better way, but not changed fundamentally. So this is the summary, and as we mentioned earlier, that now too we are taking it towards finalization. We have already received some comments during earlier public hearings. I'm not sure how many comments we received in writing, but still, I think we have maximum now 15 days left. So within 2 weeks, if anybody has any comments, they can provide the comments in writing to us, inshallah. With that, if we have any question, please feel free to put any questions in the Q&A tab. If you have any question with regard to the starting point, that will be highly appreciated. Otherwise, I'll just move to the slides. There is a question in there is a comment in the Q&A tab about the slide deck. The slide deck is exactly the same as the exposure draft, which is available in the PDF version on our website. So we normally do not share the slide deck. We share only the PDFs. So may I request Sister Noof or Brother Mai, somebody to put, okay, I think Sister Noof has already put the link for the EDs on the chat window. So I think that it is possible that any of you may try to, who want to see the text, what we are discussing, they can quickly click on the link and find it on the PDF version. In the Q&A tab, we have one question as a starting point from our dear brother Zuhair Abdul Razak. Assalamu alaikum. I would like to start by sharing an important note with everyone. As an accountant and auditor prior to my specialization in Islamic economic and finance, I believe that the current accounting treatment of Salam and Istisna-based contract based on generally accepted accounting principles do not reflect the principle of true disclosure. These standards rely on control criteria as the basis for asset recognition, which results in buyer's payment being recorded mainly as receivable or payable without recognizing the existence of an asset. However, from the perspective of Islamic finance, Salam and Istisna contracts are built upon existence of al-asl mawsuf bi-zimma, an asset described in liability presenting a binding obligation on the seller to deliver the specified item to the buyer. This view is supported by majority of jurists and to consider Istisna a binding sales contract rather than a mere promise. Brother Zohair, highly appreciate your comment. Highly appreciate your comment. I would like to mention that with regard to Salam, this issue is not there because in Salam we do it on day one. So even in this exposure draft. So this point, which is very highly appreciated, our brother Zohair has raised very good point. So first point, for Salam, we already had this issue resolved. The issue was for Istisna. Now there were 2-3 different issues on Istisna side. One issue was on the liability side and the asset or receivable side, how we show it, and one issue was tangibility side. That how you consider it on the tangibility side. Brother Zuhair, you would be happy to know that your concern we have discussed already recently with Sharia committee, and rather some of the Sharia committee members were of the view similar to your view, that their view is that we should not be recording only advance, but we should be recording why we were not, okay, let me clarify. Although it may be a bit early discussion for some of the colleagues, Brother Zohair, if you allow me, while I agree with your point, and I hope that we will be resolving it the same way you are suggesting, but maybe I'll be in a better position to explain it because some of the participants today might not have read the standard in detail like you and might not have analyzed these requirements in detail as like you. So when I reach this point of receivables and recording of asset, at that point I may be in a better position to discuss and explain it. So Brother Zohair, highly appreciate your comment, agreed with your comment. We are already in discussion with Sharia committee, and most probably before we close the standard, we will be taking this to the board, inshallah, to incorporate your suggestion, inshallah. Thank you again for being with us. and thanks for a very valuable comment. Just allow me a little bit time. So when I reach that paragraph, I'll explain it for the whole audience. It will save time for everybody. Thank you very much again. I'm keeping your question open for now. Okay, so with that, I should share the screen now, first with the deferred delivery sales. Okay, one thing I like, I think I forgot to mention in the introduction part, which I can mention now while I start sharing my screen. Just to make sure, Brother Majd, my screen is shown and it is moving.
Yes, it is. It is.
Okay. Okay. So one thing I forgot to mention here that earlier the standards there were two standards, and now we are again bringing two standards. But earlier the approach was that we define two standards as Salam and Istisna standard. Now, what we realized that Istisna standard that was already there was primarily not addressing the short-term Istisna transactions with agency, which is a very common form for export finance and some other type of financing in some of the countries. And actually, it is the more widely used actual real transaction in the markets. So while the long-term transactions, while they have been used in Islamic finance since beginning, and they may still be having some use, but we have seen that banks and financial institutions, because of two main challenges, have reduced their utilization. Number one is because the Istisna becomes a fixed price contract. So because of being a fixed price contract, for long-term infrastructure, at times you cannot control the inflation and other things. And at times, either there are Sharia non-compliances or cost overruns. So resulting situation comes like that Istisna becomes very difficult on long-term project basis, number one. Second reason is that whether the Istisna receivables or payments, the tangibility issue with regard to that, whether those assets are considered tangible for that purpose, and other issues are there, particularly for the Istisna financing part. And that was a challenge with regard to sukuk related to assets on Istisna. Although Istisna-based sukuk are an excellent solution for long-term economic development and like BOT type projects, etc. But it becomes like a practical issues with regard to the tangibility issue also came in. And that is the reason that effectively the use of Istisna in long-term Istisna projects has gone down. On the other hand, we want to promote it. I'm not saying that we don't want to promote it, but what the other hand, what we are saying is short-term Istisna transactions on manufacturing side have become common in some countries to promote particularly manufacturing sector and export finance. And we believe that that was to be handled quite in a similar way as Salam transactions are handled, particularly Salam transactions with agency. So from that perspective, we evaluated this point and we decided, obviously, I think in the earlier public hearings, we had a poll on the name of the standard as well, and poll on whether the standard should be combined or two different standards. We had polls on that, Brother Majd. I think today also we can conduct those polls about this part. Let's see when we on the name and this part. But the approach was that the main accounting need to be aligned. Brother Zuhair's point is well taken. That is Sharia application, and we already were in discussion on that point. So yes, that is hopefully to be incorporated. But considering this similarity of transactions on the short-term nature, it was decided to combine all deferred delivery sales, including Salam and Istisna, in one contract. And that is about the name of the standard. Also, I'm going to ask this question because on the name of the standard, the exposure draft says it as deferred delivery sales. But probably in other standard also where we are having on participatory ventures, there is a discussion to add the name as full name to include Salam and Istisna also to identify the respective products that we are talking about here. But the principle-based approach obviously will remain applicable. Now, coming to the second part of the standard, that initially we wanted to do only one standard, but then we realized that there were some specific challenges on the long-term istisna contract. So if we don't create separate accounting treatment, which is more closer to its exact nature, it would not be appropriate and it would not be easy to incorporate, to promote even or to practice and promote those type of products. So from that perspective, accounting board decided eventually to keep these as two different standards because slightly different treatment was needed on that part. So it's a bit summary of what is there. Some discussion will come on going forward, but if anybody has a question, please feel free to put that question. So now I take you again forward on this point. So what we are doing now in Salam accounting, we are keeping the core accounting treatment for Salam the same. Obviously, it has its own challenges, and one of the biggest challenge that we receive from the market every time is that according to Sharia, till the time the seller, the purchaser doesn't, like for example, if I'm the bank and I'm doing Salam financing, Salam using Salam as a mode of Islamic finance with the customer, so what will happen that I will make full advance Salam payment to the customer. The customer who is the seller in Salam will be selling the goods after 3 or 6 months to me. Then I will sell those goods directly in the market or through agent, and agent can be the customer himself as well. And then after that sale, I earn my profit on this transaction. From the control perspective and from the perspective of Islamic finance transactions being different from conventional, it's not only the issue of time value of money like conventional, it's about the real economic resource being sold, as we always refer to. So what is the bay? When the bay takes place, that is the point you are eligible to recognize the profit. And that is why in Salam transactions, according to earlier AAOIFI standard and according to this exposure draft as well, normally the banks in the situation of the financer, that is purchaser, is not eligible to earn any profit till the time they don't get the commodity and they don't sell it in the market. Getting the commodity itself does not create a profit. Profit is created by its sale in the market. And that is where we have this argument with regard to distinction from conventional institutions or some of the now again, I don't want to, the purpose is not to criticize others, but obviously we have seen that in some of the situations IFRS have been applied and considering Salam instruments as financial instruments rather than considering it a sale transaction. Considering it a financial instrument means that you start recognizing an accrual of interest or profit, whatever you say, from the day when you make the cash payment. This practice is not acceptable as per earlier AAOIFI standard, as per this proposed standard, and probably, as we understand correctly, as per the Sharia standard. So what we did, we combined these two practices here, and these challenges, obviously, we try to resolve. Some of those that can be resolved, we try to resolve, but some of those cannot be resolved. But with regard to the long term, we obviously try to resolve the issue. So here, then we move ahead with the standard, and I will take you through the important parts of the standard. I'm not going to read out every section, but my approach will be primarily to focus on the significant aspects. So the objective of the standard is to prescribe the appropriate accounting and financial reporting principles for recognition, measurement, presentation, and disclosures to apply in relation to deferred delivery sales transactions comprising Salam and Istisna sales transactions. See paragraph 5A for the buyers and sellers of such transactions. Sister Saira, I think, sorry, I thought that bracket is not closed, no, it's closed. Okay. So it is addressing both ends as well, as I mentioned already. The standard applies to accounting. One thing, when we say the sales transaction, why we are referring to paragraph 5A is about that we are excluding some situations as well. So the standard applies to accounting and financial reporting for all of these and shall not apply to Istisna-based development contracts. Now, when we say Istisna-based development contracts, we have put in a definition of Istisna-based development contracts. So if we feel that Istisna-based development contract would generally be long-term, but it's not necessary to have them long-term. It is possible even for short-term to follow that. The standard shall not apply to such istisna transaction whereby the institution being buyer or seller, buyer of a subject matter has intention to lease out and eventually sell it or use for themselves. So because this applies when as a purchaser or buyer, you purchase and sell. If you purchase and use or if you purchase and lease, this standard does not apply. If you purchase and lease, standard number IFRS 32 applies. If you purchase and use for yourself, it is to be followed as per generally accepted accounting principles. Now, definitions, significant definitions I'm just going to go through. Deferred delivery sales are the sales transactions carried out in line with Sharia principles and rules based on either Salam or Istisna contract, whereby the primary performance obligation under the respective contract is delivery of the subject matter. The deferred delivery sales do not include such sales transactions that are promised to be carried out on a specific future date against a unilateral promise or undertaking to sell or purchase, which are consummated through an offer and acceptance on such future date in line with Sharia principles and rules. Brother Zuhair, while we agree on your comment on the accounting side, I would request you particularly to see the definition. I think definition is in line with your comment already, but only the treatment of unpaid amount of istisna price, that is only a question how to address that part, and secondly how to because if you record it, then you record the asset. If you don't record it, you don't record, or you record the asset only to the extent of the amount paid. So that is where I'll come and discuss when I reach. I'll discuss with you again. But here particular point is that probably your one point that is there, that it's not a promise and it's not a promise. That part is clear.
Brother Omar, there is a question in the chat. Could you please confirm what period would constitute a short-term istisna and what period would constitute a long-term istisna?
First thing is, I request again that this should be like, put in Q&A tab. Just a request that please, this is from Brother Shabir Ahmed. Assalamu alaikum, could you confirm what period should be constituted? The point is that request is that please always put the questions in the Q&A tab, not in the chat window. You may see in some of the screens, you may see a more icon for more with 3 dots. There you will find Q&A if it is not appearing directly on your screen. So just try to put it in the Q&A tab quickly. We did not make it a condition for long-term and short-term. We made a condition of development contract meeting the definition. So from that perspective, we don't want to go in that debate too much. There was a discussion earlier whether we could make it condition for long-term and short-term, but now through definition, we cover it a bit. I'm coming to the definition shortly, so we cover that part. But Sister Saira, my request to you that instead of putting the questions from the chat window to the speaker, request the speaker directly to request the participant directly to put it in the Q&A tab, because this ensures that the track of all the questions and comments is also maintained. There is definition of istisna. It's primarily from the Sharia side. I'm not going in detail for that. Istisna-based development contract definition is coming here and the footnote, because here we are referring to the other standard which is addressing this subject. So we have made this long definition to clarify. Let me read it out. It is very important that Istisna-based development contracts are Istisna-based development contract within the scope of this standard is a contract of Istisna for development of an asset, normally an item of property, plant and equipment or investment property. So we are talking not about export orders. You can understand, we are not talking about general manufacturing and export orders. We are talking about something that requires considerable time and effort. So then it has conditions that it has to meet the following criteria. Number one, It involves a significant element of efforts on the part of the developer, including labor and services, which need to be compensated for in the event of force majeure in line with Sharia principles and rules and customary practices. B, it has either an element of partial control transfer through milestone-based delivery and or construction development on the customer's own property, or otherwise defines multiple performance obligations as a part of the contract that may individually be assessed and used as criteria for determining completion of a stage of completion. C, the subject matter is intended to address certain specific needs of an identified unique customer and hence may generally not have a ready market or may not be in a condition, position, or location suited for its sale to a third party. And D, it has considerable original total development period comprising of a single or multiple phases or tranches. So we did not define 12 months or anything here. We said considerable original period. Then explanation, development period in the specific context of this definition criteria shall not be confused with or considered interchangeable with the deferred delivery period. So for example, it is possible that I will deliver to you after 5 years. That is possible. But we are saying that a contract of delivering after 5 years may not necessarily require a considerable period of production. So for example, there are cars. So I want to order a car. The car's normal development period is 2 months, 1 month for the whole process, sourcing of goods, sourcing of raw materials and parts and components and assembling and painting and everything. The car may be ready, and in some of the institutions, the cars might be ready average in a minute. But let's put including sources of materials and everything, it's a 2 months time, for example. And the development and the real development time may not be more than 2 weeks. But it is quite possible that we have a long queue on the car orders, and this will be coming maybe after maybe 1 year. So the question is it a delivery period delay, or is it a construction or development period delay? So if it is, on the other hand, we can go for the aircraft manufacturing. Aircraft manufacturing may need even the original development period to be significant. This is possible, or a ship, or a bridge. So the point is here we are talking about the original development period. Brother Zuhair, we would also love to hear your comment about one more point, you and all the honorable participants here. But since you raised this one, there is another aspect to the point that you raised, and that is that according to certain fatwa and views of certain scholars, and one of which was more recently shared with us, even countersigned and approved by His Eminence Sheikh Taqiyul Usmani, that istisna is ijara in the beginning and bay in the end. Now, this is partially a justification for us for this definition part and some of the accounting treatment that we are proposing here for that part. I may not have a disagreement with you on recording the whole liability on the part of the seller. That is not an issue that we can do, or recording a whole asset in the books. But if you record the asset, the tangibility of the asset will become an issue, whether you show it as a receivable or you show it as goods. So that is a separate issue. Again, these are the issues that we have gone through in discussion. But this is since you raised this point, so this also you should see that this is view of certain ulama from the past as well, fuqaha from the past as well. And more recently, it was referred in a quotation, it was quoted in one of the fatwa, and that fatwa was endorsed by His Eminence Sheikh Taqi. I'm not saying it's view of the official Sharia board, but because we had this discussion in the Sharia committee, after that discussion, one of the Sharia committee members provided us with that fatwa. So again, no disagreement on that part of the liability, where I might be proposing the board in line with what you have said, and even Sharia committee is saying something close to that. But this element of not having the bay in the beginning, but rather having ijara in the beginning and having bay in the end, that is probably going to be justification for the stage of completion based profit recognition that we are recommending in the second standard. Anyway, this definition was related to the second standard, and that treatment is separate. Here we are discussing this one only to put an exclusion on what we are having. Then we have definition of parallel Salam, and parallel Salam, we slightly improved the definition of parallel Salam, and we simplified the accounting for parallel Salam as well. Earlier, the parallel Salam accounting was identified in the standard as a proper accounting treatment. But now what we have defined is that we have defined the accounting treatment for the buyer, accounting treatment for the seller. And since it is a Sharia requirement that two short contracts may not be combined in one contract, and it is also a condition in case of Salam that parallel Salam cannot be binding on the first Salam or dependent on the first Salam. So effectively, we simplified the accounting by saying that parallel Salam should be accounted for as buyer and seller both. So from both sides, the institution who is doing parallel Salam, which is very less common thing. We haven't seen practical examples of that. But if it happens, the point is simple, that you do both ends accounting in line with the requirement of the standard. One side you will be doing buyer accounting, one side you will be doing the seller accounting. Same applies to parallel Istisna, that we improved the definition, but we brought it like this. Then again, Salam is the Salam definition is coming from the Sharia side. I'm not going in detail. Now we are going to the treatment. Okay, no comments as yet I have seen. And let me try to just go through the treatment quickly. Now, we are saying that for Salam, 100% advance is paid. Salam cannot happen if you don't have 100% advance. So when you make the advance payment, you record an advance receivable. So we have used the term advance for Salam goods. Again, now we come back to Brother Zuhair's point again, that why we use the term advance. At one stage in the draft, when we were discussing back and forth between the working group and the board, at one stage we have written it to be as goods receivable, Salam and Istisna goods receivable, that it is its true nature. But then we got a confusion, or rather we did not get a confusion. We thought that it will give a confusion that when you say goods receivable, it may be considered tangible for tangibility purposes, for sukuk, for tangibility application in the investment accounts pools, or for transferability purposes. While as per Sharia, goods, till the time these are not received, it's a debt in form of goods, and till the time that the time is there, that is not eligible for any gain, because otherwise there can be an argument that it is a debt in form of goods. So you may be eligible to recognize a profit on that as well. While it is technically a debt until the time the debt is not delivered, even if that debt is in form of goods or even if that debt is in form of cash, till the time that is not delivered, it is not eligible for tangibility purposes, and it is not eligible for other purposes. Then there was another issue with regard to the control part, and I will, Brother Zuhair, I would humbly submit that we cannot completely ignore the control part. So what happens that, for example, there are Salam goods to be delivered after 6 months. Now something happened and somehow the commodity is not available. What happens? Either you substitute the commodity or you refund the money. What happens in case of Istisna? Either you substitute the commodity with mutual consent or otherwise you refund the money. This is the situation that we wanted to make sure that because of tangibility related issues and because putting advance makes it very clear that no return on this one can be booked. Writing as Salam goods receivable, Salam and Istisna goods receivable, or Salam goods receivable, Istisna assets receivable, that may not create the situation let's forget about it. It will create a confusion that is it an asset in the book or it's a receivable in the book. Considering these things, we originally decided about this part, but probably after having your comment and maybe probably after there's some discussions with the Sharia committee, although Sharia committee's discussion have to complete, we have started discussion with them. If maybe first standard is done with them, but second one, I think we still need to discuss with them. But the idea is that after this, maybe we'll go with the old term that we used in some of the earlier drafts, that is Salam and Istisna goods receivable. And then we will clarify that these are still not eligible because these are still receivable and still debt in a form, so they cannot be used for the purpose of tangibility, and also they are not eligible to earn any profit, because profit will be earned after your performance obligation is done, and accruing a profit here may tend to amount to riba internally. Putting it all together, the treatment may remain same, but wording may change. Brother Mush, can I suggest you can you put some of the polls now? So the first poll is about the name of the standard. So
Yes.
the first option one is we keep the name as Salam deferred delivery sales, and the second option is deferred delivery sales Salam and Istisna. So option
Yes.
one, option two, let's do the poll on that one.
We have prepared the polls. The
Yeah.
team will post it now.
I'll suggest to put this third poll also. The third poll also now. Now that this poll will be about. So the second poll was about keeping one standard versus two standards, as we asked earlier as well, I think, in the polls.
The third.
And the third one will be about the terminology. So shall we say advance against Salam goods and advance against Istisna goods? Or shall we say Salam and Istisna goods receivable? So what is the view of the majority here, how they feel that we better understand? Again, we'll have to let's understand what is from Sharia side, but still it will be useful.
Okay. The treatment on the asset side.
Yeah. Okay. Now, what is the difference of treatment appearing on the, it is the nomenclature and classification difference. The other issue is with regard to Istisna. So what we said in this one, at the exposure draft, we said that Salam, you have no option, but you have to make full payment in advance. So we said that it will be advance for Salam goods, but it will be fully paid. In case of Istisna, we said that it will be advance for Salam Istisna goods, but it will be recorded to the extent of payment. Now, which means that if you have made 20% payments, you will record only 20% as payment. Now, Brother Zuhair's comment and some of the discussions with Sharia committee mean that you need to record goods receivable at 100 and you need to record a liability to pay 80. So the treatment changes here in 6B. This is where if other honorable participants, particularly those from the Sharia side, can provide their comment as well, that will be very much helpful. So we have comment from Brother Imtiaz Abbas Hussain. Does the parallel Salam work like hedging to offset the potential losses? Brother Imtiaz, hedging normally works with margins. While Salam has a condition that you must pay full advance payment. And that is the reason that normally we see Salam on one side and promise or agency-based sale on the other side, or at times even Murabha on the other side. But we normally don't see parallel Salam transactions. But if you ask me, Brother Imtiaz, we are unfortunately living in a world where the real Islamic finance is not there. If you ask me real Islamic finance, I would say I will use it as if I'm a banker in a real Islamic finance environment, I would prefer to always have a significant amount of Salam assets, because this will always give me a liquidity tool. How does it give me a liquidity tool? So for example, I have $100 million of Salam asset portfolio. I need financing to the extent of $100 million. I have an asset liability mismatch. I need cash shortfall. What I can do, I can quickly have a parallel Salam with a counterparty, which can be an Islamic bank, etc., to create a parallel Salam of the whole Salam portfolio or some part of the Salam portfolio. That is the real use of parallel Salam, but that we haven't seen in the market. And to be honest, if you ask me, it is much, much better. If you do it in line with Sharia conditions, it is much, much better than some of the treasury products that we are using. Again, like, we are trying to do, Brother Imtiaz, we are trying to do our part of the work. And la yukallifullah nafsan illa wusaha. Unfortunately, we know some of Islamic banks have treasury related products which are not up to the mark, at times not even complying with AAOIFI's standards completely. But the point is that if you ask me, for me, the best use of parallel Salam is liquidity management. So I keep a asset portfolio because I will create cash against that. I'll create parallel Salam equivalent to the same date. So on the same dates of the delivery of my portfolios, I will create parallel Salams accordingly. And obviously I can manage the margin. So this is something that honestly I believe is very much workable. But if you ask me for hedging, normally it will not work for hedging because it needs 100% advance payment. So it will not work. Thank you very much, Brother Imtiaz, for being with us. Mostly your comments are very good, always helpful. Brother Asfar Iqbal, Assalamu alaikum and welcome, my dear brother. Thank you very much. You have commented that you prefer that it should be called against advance against goods. So advance against Salam goods or advance against Istisna goods, that is your comment. Now let me come back to Brother Zuhair's added comment. Yes, and I am aware that the goods or the asset are not yet ready and will be prepared at a later stage, which negates their tangibility at the time of contracting. However, what I am proposing is that there should be a different accounting treatment that reflects this in the financial statement, one that discloses the existence of an ongoing transaction in the presence of an asset described in the liability. Brother Zuhair, again, highly appreciate, no disagreement. I think somehow in one or another form, we are going to resolve your comment, inshallah, and trying to incorporate it. That I can commit on my part because I have discussed it with Sharia committee also. So I'll try to discuss with the board also, inshallah. Thank you very much for being with us, all of you. I think this comment for Brother Asfar Iqbal is also noted, but if we can have Brother Asfar, if you can put it in the poll. So as you can see on your screens now, there are 3 polls. One is about the name do you recommend standard issue for 2 separate standards? So first one is about 2 standards instead of 1. That is number 1. Number 2 is what about the name of the standard, deferred delivery sales or deferred delivery sales, Salam and Istisna. And third is, what term shall be the preferred, advance against Salam Istisna goods or Salam Istisna? Brother Majd, I think there is a error here. Salam Istisna goods receivable. Can you quickly edit it? Otherwise, I'm just mentioning for people but if you can quickly edit, try to edit number 3, Salam Istisna goods receivable, not Salam Istisna receivable.
Yes, goods receivables.
Yeah. Okay, so we give you some time and let's see if Brother Majd is able to edit it. Not sure about it, but let's see if he is able to edit it and let's continue. So now then what we are saying that when it converts into inventory, then when your goods are received, then you record it as inventory. Inventory accounting is similar to what we have in the generally accepted accounting principles and what we have in the Murabha accounting. So inventory accounting in line with other AAOIFI standards. So we have aligned this with that part. Inventory will be recognized mainly on the possession, physical or constructive, when substantially all risk and reward incidental to ownership are transferred. In case inventory is required on a piecemeal basis or in tranches, each tranche of inventory retrieved shall be recognized in the conditions of paragraph 7 are met. Advance for Salam goods and Istisna subsequent measurement. Now, subsequent measurement, we are saying that advance for Salam goods and advance for Istisna goods it will not be recorded as it will not be a tangible item. So it will not be eligible for any price accretion. Means that you cannot accrue any return on that because that will be considered a return on that which is impermissible. So it need to be carried at the gross amount minus any impairment, etc., if any. Then in subsequent measurements of the inventories, so inventories normally will be sold immediately, but it is all possible that for you may. Yes, Brother West.
Can we repost the poll?
Yeah, please repost the poll, please.
So maybe kindly request all those who already participated to participate again.
Yeah, please. Apologies for the inconvenience. Please participate again, please, because I think it's created again. Okay, so the subsequent measurement of the inventories also will be at cost or net realizable value if you feel that the value is going down and you are not having a customer in front of you. So in that situation, It will be subject to NRV testing. And RV is already defined as in FAS 30, impairment rate losses and owner's commitment. So in line with the inventory losses related to inventory will be recognized. I can see somebody has raised a comment again, brother Imtiaz Abbas Hussain. Is there a concept of force majeure in Sharia complied with Islamic finance? The time between payment and delivery sale may create huge loss made due to uncertain issue. Brother Imtiaz Abbas Hussain, again, in Sharia allows in some situation force majeure, but the point is that that sale transaction, it is a sale transaction as brother Zuhair identified. So particularly in case of Salam or Istisna, it is when you do this transaction, you take the risk. That risk is there, and that risk is part of the transaction structure. So from that perspective, you have to take that risk. Now the question is, can it be compensated? So I'm not a scholar myself, but I would like to mention that in case of hyperinflation situation or something like that, the OIC Islamic Fiqh Academy had identified some situations where loans or debt can be readjusted with mutual consent. Some conditions are there. There is one or two resolutions of OIC Islamic Fiqh Academy on that part. AAOIFI standards are clear that nothing is allowed to be adjusted here. On this part, but obviously the option of change of commodity with mutual agreement is there. Mutual agreement, some of the changes in prices with mutual agreement are there. So these are the possibilities that are still there. But this is not an accounting issue, and this is purely to be addressed according to the Sharia requirements and Sharia standards. Now the poll is again on the window.
Yes.
The window is open for you. I think
But the updated one is not posted.
Okay. Oh no, it's still not updated.
Actually.
Yeah, it's still not. Okay, so may I suggest that consider the last term as Salam and Istisna goods receivable instead of receivable. Our apologies for inconvenience, but let's do the poll on the same one. We'll be calling it Salam and Istisna goods receivable, not receivable. So let's do it, and we see how the response comes. So let's request everybody to comment on that one. There is another comment on the Q&A tab. This is from Lamudi Tahar. How can the Assalamu alaikum and welcome, brother. How can the industry sector benefit from Istisna? Short-term Istisna contract is used by some of the countries even for export financing. Okay, again, it's not exactly the subject for today, but I'm trying to explain the structure, why we are addressing these structures. So let me try to cover the most simple structure. So for example, I am a garment exporter in Bangladesh. I received an order of garments according to specification from that is sort of a purchase order or order for delivery for example, jackets. Now 100 jackets are to be made, or maybe 1,000 jackets are to be made and exported to US for JCPenney or Walmart or any other store. Now what happens that for those jackets, for preparing those jackets, the garment exporter in Bangladesh, they need the raw materials to be purchased. They need the labor to be paid. They need the electricity and other expenses to be paid. And not only raw material include the fabric, but it also include the supplies like thread and others. And they need to pay labor for doing this. Particularly in the labor-intensive industry like garment, it might be very important. So what happens that they go to a Islamic bank and they say, we are getting this order, we want you to do Istisna financing. So what will happen, that bank will enter into a Istisna contract for them for the same specification of goods for which the order is available, and they will finance the Istisna amount and they will purchase. So for example, if order is for for example, total $20,000, so you just make it $18,000. I'm just putting example in numbers, that they made an order for $18,000, and then they said that once it will be done, they've entered into a master agency agreement as well, and once the goods were done according to the specifications, they, after 2 months, 3 months, whatever is the time of export, then they appoint, ask them to export it on their behalf to the eventual purchaser. So now what happens that bank earns out of the profit between 18,000 and 20,000 at that point of time. This is a very simple structure. Obviously, there are more structures involved with that, but this is the more common structure of Istisna transactions and Salam transactions that we are seeing in the market. That normally it is the manufacturer, grower, the customer comes to the bank, takes cash financing against goods to be delivered later. Then when the date the goods are ready to be delivered or exported, at that point of time, as agent, they sell it in the market. Thank you very much for being with us. And while I would love to discuss more about these products and opportunities, but this is not the subject today. My priority is to try to complete the standards today in discussion. So I just discussed one of the structures to identify the accounting treatment suitability. But other than that, again, my request is that we please try to stick more to the discussion today. So then inventories, as I mentioned, that these accounting treatments of inventories are similar to what we have on the generally accepted accounting principle and what we have in the Murabaha and other standards. And then inventories will be de-recognized once these are sold to the customer. Now, till the time, or sold means, again, my apologies, handed over. Let me use the term when the control is transferred, when handed over, physical or constructive possession. So, and then there are other situations that if the control is lost or if the capacity of providing economic benefits not there, these are things to that, like, de-recognition in case of extraordinary events. But the normal event of or the situation in which they will be de-recognized is when their control, that is physical handover, is transferred to the customer. So the possession transfer means that at that point of time, you will, and this is to the eventual buyer, not to the customer itself, but to the eventual buyer. So that is the time when you de-recognize the inventory, and that is the time when you recognize the revenue. Again, advance for Salam goods, there are situations. Situation one is when it is converted into subject matter, that is the inventory. But other situations are when there are other type of issues and challenges. Those are addressed here. Revenue and profit recognition, as I touched upon earlier quickly, let me summarize simply. In the situation of export that I said, revenue will be recognized by the bank not on day one when it pays money to the customer, not on during the period of this financing, because currently it is in form of goods receivable and not in form of something on which you can recognize revenue. And the transaction structure is that you purchase the goods and you sell the goods. So once you purchase the goods, till the time of purchasing and till the time of holding the purchased inventory, you cannot recognize any profit. Only profit you can recognize when you sell the goods. And that point of time, this is where a lot of people have a challenge. They say if you do a 6-month Salam transaction, if you do a 9-month Salam transaction, 3-month Salam transaction, you cannot recognize any profit in between, which means that people feel that Salam transaction or short-term Istisna transaction, if we account for them in the same way, they are not eligible for any accrued profit during the period. This is where, to be honest, it is a real challenge of Islamic finance. On one side, then people come to us and say, oh, then what about cost of fund? Means that, okay, for investment account holders, we need to pay their returns. So again, conventional mindset, we call it cost of fund. Our answer is Islamic finance has no cost of fund. You distribute what you get. But then people say, okay, 1 month people will get more return, 2nd month people will get less return. We try to explain that who is asking you to do 90% of Salam transactions only? And who is asking you to do large amount of Salam transactions? You can do always in tranches. And not only this, Salam is normally a smaller portfolio, so it will average out. And last but not the least, we always suggest that we have FAS 35 with regard to the risk reserves. So the profit equalization reserve is a recommended treatment by AAOIFI. So Salam and Istisna, where you do not recognize a profit in the first period and you recognize all in lump sum, unless there is an additional deferred delivery sale involved with that. So in that situation, the profit equalization reserve is the solution available within the AAOIFI's framework. So if these are minor transactions, I think nobody will even observe what is happening. Difference will be immaterial. But if there are some large Salam transactions which are seasonal, which may impact the monthly or quarterly profit and loss distribution to investment account holders, then we suggest the profit equalization reserve approach is the right approach to manage that part. That is again, not subject for today, but it is covered in FAS 35, which is already very much there. Now, revenue shall be recognized at gross value at the time of sale of subject matter to the eventual buyer, either directly or through an agent, which shall coincide with the time of transfer of control of inventory. Explanation 1. The gross revenue shall be the total amount billed to eventual buyer directly or through an agent without any deduction of agency fee or incentive payable to the agent. Explanation 2. The buyer shall not recognize any revenue, hence profit, till the time the subject matter of Salam or Istisna transaction is not sold to the eventual buyer. At time for the risk purposes, in the example that I gave, what happens that instead of keeping the price of $18,000 and $20,000, the bank will say, okay, I will purchase for $16,000 because I want to be sure that if it cannot be exported to that JCPenney or Walmart or whoever it is, it can still be sold in the market and I can still recover my money. So I'll purchase it for 15 or I'll purchase 16. Customer may agree that because it is possible that the financing need is only 15. But then they will say, why I give you profit of 5? In that situation, this is too much. You are charging too much profit. In that situation, the structure may include an agency commission. So in that situation, the bank will say to the customer that, okay, we pay you 15 and we purchase from you at 15. We know that the expected selling price is 20. You can try to sell it for 20, more than 20, less than 20. But what we suggest is that we will make you an agent and we'll say that if you sell it anything more than 17, that will be paid to you as agency commission. So this way, the risk of price volatility is covered. And this way, the transaction becomes more workable. But in that situation, what we have suggested here is that agency commission is not, you should be recording the sale at gross value and showing agency commission separately rather than just saying, okay, we paid 15 and we are going to get 17 net. So we just record sale at 17. No, your civil was at 20 and you paid agency commission of 3. So from that perspective, you need to be accurate in accounting and to keep it in line with the true spirit of Sharia. Then we have one specific situation that if you purchase on Istisna or Salam and then you sell on Murabha or on Musawama on deferred payment sale basis. So in line with the generally accepted accounting principles, also we have tried to align. We are not saying we are not following GAPS or IFRS, but we try to align maximum and to justify what is better. So the treatment of FAS 28 on Murabha will apply on this part. So what we will do, that there is a credit part and there is a cash price. So if there was no credit and there was cash price only, what would be that value? That to that extent, you recognize the profit when you transfer control. And the remaining amount of profit, you defer it like you defer in case of Murabha and other deferred payment sales in line with FAS 28. So this is a treatment that is defined and clarified here and cross-referred to the FAS 28. Then we have disclosure requirements about accounting policies, about balances, about B3 is about commitment. If we incorporate the comment by Brother Zuhair and record a liability, then this will not be a commitment, it will be a liability part. Brother Imtiaz Abbas Hussain has raised a point, profit will not be recognized in say 6 months Salam transaction, but what about losses? Brother Imtiaz, loss will also be recognized on that date, but the point is if you can anticipate the loss, it will be identified in 2 situations. One is where you identify that the net realizable value of the inventory is also going down and customer may be running away and there might be no customer. So inventory and RV adjustment will partially record the loss or may fully record the loss. Secondly is before inventory, at the stage of inventory, it is NRV. Before inventory, it is the issue of impairment on the Salam goods receivable or Istisna goods receivable. So the requirements of FAS 30 will apply in both situations. So yes, loss will be recognized on a prudent basis. That is, you all understand that this is the preferred accounting. So it will be a provision or based on prudent allowance for impairment or adjustment for net realizable value. Thank you very much, Brother Imtiaz Abbas Hussain. Normally you raise very good points. Highly appreciated. Again, Brother Zuhair has a point. What I'm proposing is the recognition of the asset at the moment the contract is concluded as a right established by a document that proves the right. This document can serve as evidence of binding obligation on other parties. Such a right can be traded or sold, thereby creating the possibility of selling and transferring the right in the market. This approach would reflect the contractual reality in the financial statement and enhance the principles of disclosure and transparency. Brother Imtiaz, first part of your comment is absolutely agreed. I think we are going for the same direction. First part of your comment. And I think Sharia committee has also agreed, as I mentioned. So first part is okay. But when you say such a right can be traded or sold, sorry, brother, I think Sharia committee and AAOIFI Sharia standard won't allow it. And if you ask me, I personally would also not be in favor of this. And again, can it be traded or sold is not an accounting issue. So I won't be going into that direction, Brother Zuhair. I'll leave this question to the Sharia boards and the Sharia board of AAOIFI to decide. As per today, AAOIFI Sharia standards don't allow it. AAOIFI Sharia standards don't allow it. And I think this is the standing position of AAOIFI since beginning. From that perspective, the second part of your comment, again, Brother Zuhair, we will take your comment to the board, to the Sharia committee as well if needed. But what I would like to humbly submit is that we disagree with this point. And even the Sharia committee, when they agreed with first part of your point, they have disagreed on the second part. This is very clear that it cannot be sold as per Sharia standards. But again, we highly appreciate your input. Your comment will be taken again. Brother Sadaqat, our dear brother, has raised a point. If the commodity could not be delivered on its deferred delivery date due to natural disasters such as flood, earthquake, or war between countries, is there any penalty for delay in delivery, or how this issue is addressed in AAOIFI standard? Sadaqat Sahab, Assalamu alaikum and welcome. And you raised again a good question, but I'm a bit like, stuck here because we have to manage time. And this is a Sharia issue, not accounting issue. In a nutshell, if a delivery is beyond, is because of beyond, force majeure or anything beyond control, a substituted commodity can be done or amount can be refunded. These are the choices. So you can sit with the customer and try to get a substituted commodity. Even according to Sharia, the person has to purchase it from the market. So if it is available in the market, he has to purchase it from the market. If he doesn't purchase it from the market, you can force him. If you have a security available from him, you can force him to use that security to purchase it from the market and to deliver to you. He can, but if it is settled in cash, he cannot give you more money. But if it is settled in form of a substituted commodity, he can give you a commodity of a higher price or a lesser price. And that adjustment, there will be impairment can be booked as an allowance. But if he gives a commodity of a higher price, still you don't recognize a profit. You will recognize the profit only when the goods are sold in the market to the eventual seller. However, in a nutshell, the Sharia standard is the one that addresses these issues. And as I said, either cancellation of the transaction and refunding of the money or providing a substituted commodity is the solution. We have touched upon this one in accounting side that it will be an event of the time, but we have not gone in detail for that part. Thank you very much, Sadaqat Sahab, for being with us and all your very important comments raised. Anonymous attendee, does the standard elaborate on the treatment of discounts in Salam and Istisna financing? We have just touched upon that part. We have not gone in detail. Other things will be in line with FAS 1 and other generally accepted principles and AAOIFI framework. Brother Sadaqat has another point, revenue and profit recognition. If the purchase price of goods was paid on 1/10/24 and delivery was received after 6 months and commodity sold on 1/5/24, 1/5/25, I think 1525, I think this one. Profit amount is 10,000. How income can be recorded? Full income on 1525. Yes, it is 1525 full income on 12525, and it cannot be split in between because at that point of time it was a debt. It was a debt in form of goods, not in form of cash, but it was still a debt. So considering that part, and that was the reason that we originally preferred to use the term advance to avoid any confusion on that part. That was the reason at our end. However, now we feel that like after some of the comments, maybe we'll change. Let's see the poll results, brother Majd. How many people have responded till now?
We will show that
47.
team is working on that.
47 out of 90.
Oh, just a request is just a 50% response. So if we request all of you to try to respond quickly, let's take a couple of more sections and then we come back to this. Then presentation on disclosure, we have these requirements of, again, I don't need to read all of it. If anybody has comments on the presentation and disclosure requirements, you are most welcome to provide. Then we are coming to the seller side. On the seller side, we are saying that it is a counter accounting, so recording a liability. So 26B will also be impacted by the comment raised by Brother Zohair, that because we were saying that you record the liability as and when you receive the advance, and remaining part you record it as we said that how to put it better. We said you record liability to the extent of advance received. You don't record the liability for the full goods, but you record a commitment and show a commitment as a disclosure. Now, after Brother Zohair's comment and Sharia Committee's comment, if the accounting board agrees, if they don't have any different argument on that part, it may be recorded similar to what we are having in the case of Salam, and there will be receivable and payable both recorded. So other than that, I think we are on principle base, we are the same. It will not impact the profit or loss. Let me clarify one part. It will inflate the balance sheet. Means that if you go with the treatment written in 26B, if I have received, like I'm the customer in that situation, the example of Bangladesh that I gave. So if I'm a customer, I receive 15,000. So what I will do, I will, and again, we were assuming full lump sum, but for example, I have received 5,000 out of 15,000. So I was supposed to record a liability of 5,000 and show a commitment of 10,000. But then now after changing this treatment, if we change this treatment, what will happen that I will record a liability to deliver Salam and Istisna goods, like 15,000. And since I have received 5,000 in advance, I will reduce it by 5,000. So I will show a net liability of 10,000. This is something that, again, we need to find out how we will be doing it if we agree to the change suggested by Sharia Committee and Brother Zohair. But this will not fundamentally change the accounting treatment with regard to the recognition of asset, liability, and liability. It will inflate asset and liability, or it will nullify the things. But effectively, even can I adjust that 5,000 received from this liability, or I can still record that 5,000 as a maybe I will still record, because Brother Majd, I just noted down for internal purposes. You and Sister Saira can note it down for internal purposes. That one option is that we completely keep the treatment and we keep our receivable and payable separately. That is also a possibility. How we do it is something that we need to discuss. So if you both and Sister Marjan, if she's there, if you guys can note it, we can try to resolve it before we go to the board. We need to make a proper recommendation to them based on these recommendations. Again, the treatment is normally opposite of what we are having. So, but the point, let me clarify. I'm seller here. I'm seller here. So my profit is technically when I make the sale, but it is based on generally accepted accounting principles. It's not like, so I'll be recording the transaction like a normal sale transaction for myself. So with generally accepted accounting principles shall be applied in respect of inventories, etc. So if I have in process inventories, etc., I'll follow IFRS or other generally accepted principles which are applicable in the respective country about in process inventories, etc. So this treatment is simplified. Most of the accountants understand it very well. Revenue will be recognized when I sell it to the buyer. So sell price minus cost of sales is my profit. Again, it will be recognized at one go, except for if it is a Istisna transaction with deferred delivery sale, then deferred delivery elements shall be segregated and recorded as per FAS 28. Then presentation and disclosure requirements are there. I'm not going to read them in detail. Then we have related accounting treatment. So we clarified that parallel Salam and parallel Istisna accounting, we are not defining separately, but rather, as I mentioned in the beginning, that seller and buyer both will be following the accounting treatment on the asset and liability side, which is defined in this standard without mixing together. So we have used the term on a mutually exclusive basis. Then with regard to for one part of subsequent changes in price of subject matter, in some situations we can have a mutual agreement for change in price of the subject matter due to certain factors. That it will be an event of that time. There is a situation in case of Istisna where there can be what we call Shart Jazai, where Shart Jazai means that either based on the delivery, early delivery or late delivery, the price can be changed. That is already written in the contract that if you deliver by this date, we pay you more. If you deliver later than that, we pay less. Or the normal delivery date is this, but if you try to make effort and deliver it earlier, we pay you more. So these conditions in case of Istisna, these can be included in the contract. So from that perspective, this is understood. Anonymous attendee again raised a point. Salam Istisna financing getting recognition Islamic mode of financing. Yes, that is correct. In some of the countries, particularly the short-term Salam and Istisna are a significant part of the financing. Long-term still not. But long-term used to be with Islamic Development Bank and some others. But because of certain other challenges, now Istisna is not being used particularly because of the fixed price challenge, tangibility related challenge. But other than that, we believe that Salam and Istisna in some of the markets have grown up. To be honest, they have grown up in the markets where you don't find tawarruk. Because if you find tawarruk, you have a means for cash financing. So although it's less preferred, but it's easy to execute as a cash financing transaction. But if you don't have a cash financing transaction like tawarruk available, then you resort to the real Islamic finance transactions like Salam and Istisna because they allow you to have cash financing. Effective date is proposed to be 1 January 2027. Since principal accounting treatment is going to be more or less same, I don't believe this would be a big issue. We are trying to finalize the standard within the current year. But if you feel that there are issues in implementation that may take time, then particularly the practitioners who are currently following FAS 7 and FAS 10, they can kindly update us with regard to this part if they feel that more time is needed. However, we expect that we will finalize before year end 2025. So probably it will be good enough time, more than 1 year time available, inshallah. But if you feel that more time is needed, please let us know in the comments. Brother Muhammad Imran has raised a point, but my apologies. The point is not very clear. Asset-based financing versus Salam and Istisna financing. Honestly, I'm not very clear, Brother Muhammad Imran, or your point. Welcome. That we are happy to have you here, but we'll be highly appreciating if you can clarify your point, please. Now, Brother Majd, number one, the poll result. The poll result.
Announcement,
so
yes.
For the change of, for keeping two standards, the majority is in favor of two standards. The vast majority is in favor of mentioning the name Salam and Istisna in the name. Okay, it's still the majority is saying advance against Salam and Istisna goods. I think this is, because to be honest, my personal opinion had been in favor of this one, and we had discussions on that part. So let's try to take note of these points, and we'll be taking this poll result to the board as well. Before I move to the second standard, Brother Majd, I think BILIF the video is becoming overdue. Our apologies for the technical glitch. It was running, but somehow the sound was not coming.
That's right.
So
That's
let's have that one before we move ahead, please.
So, dear valued participants, allow us again to display the brief film on the role and activities of BILIF, Brunei Institute of Leadership and Islamic Finance, represented today in the decision by Mr. Aero Iswandi Muhammad, acting CEO. Of course, in the field of training and human resources development and capacity building, particularly in relation to Islamic finance and its different areas and specializations. I hope this time the film will, inshallah, be operative.
Change. It starts with a spark, a desire to learn, lead, and excel. In a world of constant change, standing still is not an option. Every day presents new challenges. We need a place that understands this journey, one that inspires, equips, and challenges us to rise, where ideas are shared and innovative breakthroughs are born. We need real, actionable solutions, skills to lead with impact, knowledge to stay ahead, tools to excel in a rapidly evolving world. It's all here. BILIF provides not just programs, but experiences that truly matter. Tailored solutions to meet the unique challenges of our careers. Certifications that open doors, connections that help us grow. It's not just about learning, it's about advancing. BILIF isn't just an institution. BILIF is the solution provider for professionals, for growth, for the future. Since 2010, BILIF has been part of this journey, standing side by side with professionals across industries. As a multi-award-winning institution, BILIF partners with leading global institutions, bringing world-class learning to a broader audience. BILIF's success is built on the relationships we've nurtured and the goals we've helped achieve beyond the classroom. It's all backed by a strong, talented team of minds committed to understanding your challenges, your aspirations, and your vision for the future. Brunei Institute of Leadership and Islamic Finance. BILIF. On course for success.
So, thank you our team, and all the best to BILIF and its management, and our brother Aero Muhammad. All the best in your endeavors. We may need to resume now, Brother Omar, or do we need?
Thank you very much, and it gave me opportunity to read a couple of questions that we have received in between. So Brother Zohair has raised about one point. When we talk about disclosure, we refer to clear and transparent presentation of information to public shareholder stakeholders. This requires that payments made under Istisna cannot contact be removed from the traditional classification of receivable and instead be accompanied by appropriate presentation of rights and obligation arising from transactions in the financial statement. True disclosure is not limited to presenting number. It also involves clarifying the nature of contractual relationship and financial implications, enabling users of the financial statement to make well-informed decisions. Highly appreciate your comment, fully agreed. Only disagreement till now what we have got is about the second part of your last comment, that was related to saleability or transferability of that one. That is an issue from Sharia side. Other than that, this comment is also appreciated and probably will be changing as I mentioned. Sadaqat Sahab again, Assalamu alaikum. Presentation is good. I suggest to include Sharia prohibited goods and commodity against which the financing by FIs against Salam Istisna must not be done to restrict misuse of. The point is, Sadaqat Sahab, we say that our standard is to be read in line with Sharia. So if something is not done in line with Sharia, my standard is not there to address it. So for example, if somebody says that they did, for example, somebody did Salam in gold. For example, if somebody did Salam in gold. Now, my standard is not to address that one, to be honest. Like, I cannot say that this standard applies on this transaction because this was not meant for it. So from that perspective, Sadaqa Sahab, our approach is to keep this matter in the hand of Sharia. We do not want to but again, again, your point is well taken. We'll take it to working group and board. But my point is, anything prohibited, either impermissible generally or impermissible for Salam purposes, that would be like, a completely different argument. Again, irrespective of we write it here or not, irrespective of what we write it here or not, there is a disclosure requirement in phase 1 that if you have by mistake done any Sharia non-compliant transactions or anything like this, you need to make appropriate disclosures. So that part is already there. So Sadaqa Sahab, I think we can try to resolve it by that. But your comment is well taken. Thank you very much. Let me move ahead to the second presentation for today. This is on Istisna-based development contracts. Just to confirm that my screen is showing, can you see my screen?
Yes, it is visible. Started screen sharing, but still
not, or it is
still not. The message is there. Okay, now
okay.
it is. Yes.
Okay. 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 I don't know why it jumped somewhere. Okay. Okay. Just to confirm, I don't know what is happening, but somehow it's moving very fast. I wanted to move fast because of limitation of time, but not that fast the way it is moving. No, it is jumping some of the pages altogether at the same time. Please just allow me a second to try to find out what is it. When I click on it, it moves maybe 15-20 slides at the same time. Okay, I think for me it is moving now. Okay, I hope it moves for everybody. Okay. Okay. Just to confirm that you can see the screen now.
Loading.
Okay, it's moving.
Yes,
it's
yes.
moving. Okay.
Moving reasonably.
Okay, good. Okay. Okay. So now we did the accounting part for this one, but why we are asking for this separate standard for long-term or development-based contracts is simple. That we talked about this issue that for 3 months, 6 months, 9 months, you cannot recognize the profit. But what happens if you have a sale transaction for 10 years? There is a Istisna-based development contract that completes in 10 years. There is a road, there is a bridge, there is something that completes in 3 years, 5 years, 7 years. You don't recognize any profit for 5, 7, 8 years. It will make it impracticable, completely impracticable. This is why we went back to some of the basics. Okay, earlier FAS 10, that is still in effect, is based on International Accounting Standard 11. When the IFRS changed for 11 standard, the withdrawn standard number 11, they applied the condition of 5-step model on the construction contracts as well. So if you have identified situations where the performance obligations are met, then you can recognize it proportionately. Otherwise, you cannot recognize proportionately, particularly if the lump sum sale is to be done. This is where we realize that we need to keep the original accounting available with some of the improvements and trying to align as maximum as possible with IFRS and other generally accepted accounting principles, not because we just want to align with them, but also because we want to find solution, on one side, again. So here we are slightly different from IFRS, not fundamentally different, but what we did is that this standard is also based on FAS 10 and IS 11, old IS 11, which is now superseded, which means that in a nutshell, the seller will recognize profits based on percentage of completion, subject to certain conditions that are to be met. Those conditions are primarily based on piecemeal or like based on the justification of cost. And as I mentioned earlier, that istisna has an element of effort. It has an element of ijara in service ijara in itself as well. There are some arguments that we identified within the Sharia parameters that istisna transactions have ijara element in it, and that justifies that you recognize profits over a period of time as well, because it's not just an absolute sale, but it is a sale with a significant amount of effort. And that justifies slightly different accounting treatment as compared to what we are doing on the other transactions in the standard that we discussed with earlier. Now, for normal Salam and Istisna transactions, we are saying that the performance obligation is to purchase and sale, you just sell it. But the issue for the seller, because in the other ones, the issue for the seller was not significant, because he was doing a normal manufacturing cycle and a little bit more time in delivering. But if it is a considerable development period, then what to do? So if the bridge is going to take 3 years, you have to recognize some revenue, obviously according to justifications within the accounting framework, but you cannot say that, okay, I will not recognize any revenue till 3 years or recognize whole amount of profit after 3 years, which will make it completely impracticable. So we decided that in order to promote Islamic finance real practices, which include Istisna-based development contracts, it is very important to define accounting treatment, which is more practicable, more workable with the markets. Now, I'm not going to read the standard again word by word. I'll just take you through this one. So this standard will be segregated from that one. So if you meet the condition of Istisna-based development contract, then you come to this standard. If you don't meet that one, then normally all other Istisna transactions will be dealt in line with the standard that we already reviewed. Now, objective scope, I'm not going to repeat. Generally, these things are already discussed. And the definition, the most important definition is already discussed. We have used the term not buyer and seller, but customer and developer to distinguish it from the last one. And particularly, we use the term developer because we did not want to call it only a seller. Again, developer for Arabic, obviously, Sania may include manufacturer, developer, all that. So for developer, we use the term with a further explanation as well. So we said that it is the manufacturer, constructor, producer, processor, fabricator, or builder, etc., who develops and sells the subject matter under a Istisna-based development contract. But condition is who develops and sells. If he develops and takes service charges, then he is not developer for the purpose of this standard. Then we have a definition of Istisna-based development contract already discussed between us. It is in paragraph 5, so we already discussed it. We'll just read that. A stage of completion method is something that there is a stage of completion method, sorry, my apologies. Also at times referred to the percentage of completion method is the recognition of revenue and expenses by reference to the stage of completion of a development contract. Under this method, development contract revenue is matched with the development contract project cost incurred in reaching the stage of completion, resulting in reporting of revenue, expenses, and profit, which can be attributed to the proportion stage of work completed. Okay, now there are assessment factors. These are the factors that we discussed already when we were reviewing the earlier standard, so I'm not going to repeat that part, but the quick point is that it has to be generally long-term, significant element of efforts need to be involved. It has either a partial element of partial control transfer. These are the conditions. If these are not met, then it will not be there. So either an element of partial control transfer. So if milestones are defined in the contract, that is good. If the contract or the construction or development of the customer's own property. So if you are doing the manufacturing for example, if I'm a contractor, I'm doing it on the government owned property and I'm constructing a bridge there, then I cannot take over that bridge and take it somewhere else. So it means that an element of partial control transfer is there. Or it otherwise defines multiple performance obligations are part of the contract that individually be assessed and used as criteria for determining the stage of completion. So these are the conditions that if if these conditions are met along with other conditions, then it will be eligible for this percentage of completion method-based accounting. If it does not meet this criteria, including that subject matter is intended to address certain specific needs of the identified unique customer. So again, you cannot take it over to anybody else. You cannot transfer it. Similarly, okay, I can see we have a hand raised by Ashri Sharbini. Please go ahead, please. You want to speak something? I can raise your hand raised. Okay, I think maybe by mistake or they can't hear us. So let's move ahead. So these are the conditions. The conditions we discussed already and we explained already. So I'm not going to take that much time on that part. But what we are now saying, I'm the seller, I'm the manufacturer, developer. It's accounting in my books. Now, whatever are the development contract project costs, I will recognize them as project cost. And obviously, it will include all the costs that are directly incurred, etc. Some of the overheads that are eligible for that, some of the costs that are chargeable to the customer under the contract, they all are added. Then general and admin expense, etc., are not to be part of it, and this may be reduced by any incidental income. So, for example, if the same assets which are used for doing that project are also used for some other work, and there is some additional income coming, or if you sell some scrap, something, whatever happens that you can use, so that will reduce the development project cost. Some of the trial runs may also be there. Development contract project costs include the cost attributable to development project for the period from the date of securing the contract to the final completion of the development contract or delivery of the subject matter. And other direct costs are also included if they are agreed with the counterparty. Receivables from the customer and development contract progress billing as a corresponding liability shall be recognized as and when contractually agreed progress billing are made to the customer. And then at the end of each financial reporting period, development contract project cost in respect of each development contract shall be carried at cumulative cost less allowance for impairment. Brother Harun, if you can just note for yourself, Brother Maj, Brother Harun, I'm not sure whether Sister Marjan is here, but I think it needs to be noted that if we incorporate that comment on the other standard, how we adjust the numbers here in this standard, that we need to check before we go to the board. So if we make some recommendation on that part in line with Sharia committee and public hearing comments, then we need to do some background work ourselves first. But Brother Harun in particular, I think we'll have to recheck the accounting entries if they change and how they change. One option is that we keep receivable and payable separately and without impacting the contract accounting. I think that would be the best approach if you agree with me, Brother Harun in particular, if you can take note of it. So let's move ahead and then obviously allowance for impairment need to be recorded if it is there. And subsequent measurement will include the deferred development contract profit. The way accounting is done for development contract project costs, it includes the profit also to be accounted and liability to be recorded. Receivables from the customer's part is the one where we will have this thing, but again it depends because do we record the whole amount of receivable on day one, or we record receivables as per progress billing. Here progress billing based receivables are recorded, so shall we record a separate receivable or something? That is something that we need to identify in line with the comments that we have already received. Now those who are again, I don't want to go in the nitty-gritties of the complicated accounting for construction contracts, but those who understand that there is revenue recognition in the construction contracts is primarily keeping a separate a record of cost and revenue and profit as compared to progress billings. So we distinguish the progress billings because progress billing may include a 30% advance. Now, 30% advance does not constitute a revenue and revenue immediately. Or as and when the work is completed, the progress billing is taken forward to the next level, and you start booking more receivables according to the situation. So since it is a bit complicated, the purpose here is not to go into the details of the accounting entries or those complications, but rather the purpose is to take overall comments on the standard and the approach. And again, we'll go to further details only if very able participants here make any specific comment with regard to some very specific treatment or nitty-gritties related to that. So in a nutshell, what we will do that we'll keep progress billing records, but at the same time, the main revenue recognition will be dependent on the percentage of completion. Percentage of completion, if there are milestones, you record according to that. If there are if not there, then based on the engineering estimates as well as based on the cost incurred to date, these will be the approaches normally that will be applied. Even for the progress billing that we make, expected credit losses in line with the AAOIFI Phase 1 will be recorded as a part of subsequent measurement. The contract development contract progress billing can be a net asset or net liability situation depending on whether you build more and expense less or you expensed more and build less. So depending on that situation, that whether the revenue is more and progress billing is less, in that situation, you will have a receivable. If the progress billing is more and revenue is less, in that situation, you will have a liability. Normally, it is a liability situation because normally in construction contracts, you need advances from customers. The revenue will be recognized at the end of each financial reporting period on a stage of completion basis if and only if the total contract development cost can be measured reliably and it does not exceed the total contract revenue, and the stage of completion of subject matter contract may be reliably measured through pre-agreed project milestones in the absence of the same through reasonable estimates based on engineering surveys or a cost incurred. It is probable that future economic benefits shall flow to the institution. And accrued receivable against development contract shall be recorded as receivable against the development contract progress. And there is a rebuttable presumption that on all Istisna-based development contracts, the revenue may always be reliably measured as Istisna is generally a fixed price contract. However, in certain circumstances where variations in revenue are expected due to variation in delivery date, extra work or change in specifications, etc., prudent estimate of revenue shall be applied for the purpose of application of stage of completion method unless until the time a higher amount of revenue is virtually certain. So if you are having a revenue which is you are negotiating, trying to increase the price, till the time that price is not increased, till the time it is not contractually agreed to increase the price, or other conditions to increase the price are not met, till that time you will not be eligible to increase your profit part. But once it is done, you will adjust the profits. So again, as I mentioned, I would not be going in all the details, but yes, very important point. So for example, if the contract at this stage include even further deferred payments. So for example, the example that that you have as a developer, there are you are booking in the books of the developer, and when you sell as the developer, you have payments to be made by the customer after the date of delivery of the project. In that situation, like Murabaha or other deferred payment sales, there would be an element of deferred profit that can be segregated and recorded over a period of time. So for example, if the customer makes two payments, the 50% payments till the time of delivery and 50% after the payment delivery. So then in the situation, you will not recognize 100% of the profit on the date of delivery, but you will recognize 50% profit on the date of delivery, and 50%, roughly I'm talking about, 50% you will be recognizing as a deferred profit, which will be amortized over a period of time in line with the requirements of other AAOIFI standards like FAS 28. So then revenue and cost of revenue will be mainly based on the percentage of completion, and it will be recorded in line with the practices. Again, I'm not going in detail of the accounting entries, etc. If anybody has any specific question, obviously we can take it. But since we had to cover two standards today, so I have to be a bit quick to make sure that we cover at least all the main concepts and are able to at least take all the comments. So application of stage of completion method, development contract revenue is recognized in the statement of income in proportion to stage of completion. Development contract project cost, like cost of sales, is recognized as an expense, again in the same proportion. So the inventory value can be different than the cost recognized till to date. This is just we need to keep in mind. Then onerous loss situation. So if you feel that it's a fixed price contract and it is getting into a net loss situation, then you need to recognize the onerous loss whenever it comes to that situation. This is in line with the general, even on the revenue recognition side, and this is in line with what is there in FAS 30 as well. And if there is a change in estimate of revenue, then it will be done when this is when it is that when it is adjusted. So a change in estimate with regard to total development contract revenue and total development contract price that results in an increase or reversal of a previously recognized onerous loss shall be immediately recognized in the statement of income. So what happened that today we estimate that we are going to a loss. Then either the revenue is increased or the cost is decreased. And then you recognize that now there will be again a profit situation. So whatever was recognized as an onerous loss in past, it will be immediately recognized as a gain. And then going forward, you will continue the percentage of completion method. Derecognition requirements and these things, I don't think we need to go in that part. The main issue is with regard to that delivery, but now inability to assess the stage of completion. So we are saying that if you are unable in the beginning to assess the stage of completion, etc. So in that situation, obviously you cannot apply this standard. You will have to go to the other standard that we already reviewed. But if at a mid stage, you find out that now a stage of completion for any reason cannot be estimated because of different issues, project being delayed or other issues. So in that situation, if you identify that for any reason percentage of completion may not be identified clearly, because for example, you completed mid of the project, but you identified there were defects. Now you need to correct the defects and only after that you can say, okay, we are back to mid stage. I'm just giving examples. So it means that at this point of time, you are unable to assess where do you actually stand. So if it happens, then it has to cease the accounting by this one and it has to go to the deferred delivery sales basis. And if it is within the first period. So if within the first period, you identify this one first financial year, if you identify this one, you go back to the other standard. If you identify it later, because you are already doing accounting in line with this 1 year, 2 year, and then you got to this situation, then you will stop this situation recognizing any further profits. Again, onerous situation will be recorded wherever you are in an onerous loss situation, it will be recorded accordingly, and then presentation and disclosure related requirements are there. Again, I'm not going in detail for that. And then we come to the buyer side. On the buyer side, it is again we are asking again same more or less the percentage of completion. But if you don't have that data about percentage of completion, then you need to record it only based on the payments made. Now, normally in Islamic finance, you don't need it. But again, because you are buyer, but you will be needing it if it is a parallel istisna arrangement, then you will be needing it. And the customers of Islamic finance will be needing it. So in that situation, in long-term contract, normally they will work this way. But we decided, as I mentioned earlier, that we decided to keep both the developer side and buyer side and in the both side treatment. So that's why we have kept this treatment. The treatment will be based on comparatively, it's slightly simplified as compared to what we have on the other side. So advance against Istisna-based development contract shall be recognized as and when the advance payment is made, if any, in line with the contractual arrangement that advance against Istisna-based development contract equivalent to the amount of cash paid. Again, the comment from Brother Zuhair is taken and noted. This may impact, if that adjustment is made, that may impact here as well. Then we have this advance at the end of each financial reporting period will be carried at its carrying value, means that you will not be having any adjustment to its value. If there is an impairment situation identified in accordance with FAS 30, it will be addressed. Project in progress. Now, project in progress is like sort of inventory. Now, here tangibility issue will also come. That if I made advance payment, and there are identified milestones or identified project situations, then this may be a situation of tangibility. Again, tangibility again is not accounting issue. but you need to distinguish it from the advanced stage. So if you have mid-stage building standing there, the question is, again, ownership to that building is not transferred to you. That is the problem. The problem is it is still a debt in form of kind. It's an in-kind receivable, and that may still impact the tangibility part. That is what I'm just trying to explain on the tangibility part, which is not my primary purpose. But what happened, advance is now converted into tangible goods, but still those tangible goods are to be received, not yet received. Till the time you don't receive them, you cannot sell them. All those conditions will be there. Now, this liability should not be confused with progress billing. This is just a clarification for the accountants for just clarifying that part. Other than that, this will be advance being transferred to this one. At progress billing can be more than that. Progress billing is because even in the beginning, there can be a 30% advance. That is progress billing. That does not mean that is not liability for that purpose. This liability is to the extent of work incurred already, cost incurred, and based on percentage of completion, how much actually becomes due. So this part is again, I can see no question. So either things are too complicated. I know. To be honest, when we were ourselves students, we used to consider, and when I used to train on Istisna accounting under AAOIFI in the initial days, I always used to say that even within accountants, the chartered accountants and CPAs, construction accounting was not considered simple. And Istisna accounting becomes a bit more complicated than construction accounting, because you have the added element of deferred profit, etc. So it becomes even more complicated. So if we are not having questions, it may mean that it is too complicated. But anyway, I am available, and I hope that it remains understandable. So if anybody still has a question, any clarification that you have in mind, please feel free. We are here to try to answer, and we are here to take your comments to the respective board and the working group. Acquisition of the subject matter, that is when the project shall stand concluded when the subject matter is delivered from the developer to the customer. That is time when the customer essentially acquires the complete control and hence substantially all risks and rewards incidental to ownership of subject matter. A delivery of the subject matter not matching the contractual specification may trigger a need for reassessment of impairment thereon. So if it is not exactly matching, then impairment might be risk. As I said, that this side of accounting is slightly easier because you are just recording the asset and liability. You are not recording the whole of the even the revenue part you are not recognizing. Only complication can come when Islamic Bank is a buyer under this one and seller in a parallel contract. That will be a situation where you have to apply both accountings, so it will remain complicated. And however, here we have the presentation and disclosure requirements. These are just quite similar to what, again, on the counter side, these are similar to make sure with the other disclosure requirements that we already discussed, just to make sure that these are these are properly, transparently disclosed. If anybody has a comment on disclosure requirements, again, we can take it. About the parallel part, related accounting treatment, the parallel part, we have just tried to clarify. Again, it is the same thing as I mentioned. It's the same thing that you need to apply both end of accounting. But we are saying that in case of parallel Istisna-based development contract, whereby the developer enters into a parallel Istisna-based development contract with the parallel developer, the developer shall follow the accounting and financial reporting requirements as prescribed in paragraph 6 to 34. In this case, the development contract project cost shall be based on information about the stage of completion provided by the parallel developer and any other direct costs attributable in line with the requirements of this standard. So this is the way that we have simplified accounting for parallel Istisna, that we have not gone in that much detail. Rather, we have kept it simplified, that you apply that side of accounting with this minor change approach. This is when the customer enters into parallel Istisna development contract with parallel customer. In case of a customer of parallel Istisna-based development contract entering into parallel Istisna-based development contract with the parallel customer, the customer shall initiate accounting as developer in line with the requirements of paragraph 45. Any profit arising as a difference between development contract revenues and corresponding development contract revenues, depending on the stage of completion of subject matter, shall be immediately recognized. There is a footnote to the last point as well, that at times the sequence is not given, that which contract you sign first. So if the bank is having a parallel istisna, so it depends, the treatment slightly depends on whether you started which side of the contract you started first. So that is given, that normally this is the logical sequence, but it can be other way around as well. And then that's why we define paragraph 47 and 45 and 46. And then if there is an onerous situation that you know that the contract may end up in loss situation, then you will incorporate. Any subsequent change will be recorded when it is virtually certain. We just defined that part. Earlier standard included Sharia principles related to that in the standard, which we have not included, and we have kept them referred to the respective Sharia standard. Effective date is the same for this one. Again, I would say that principally we did not change the accounting treatment, although we defined additional accounting treatments, but it's still, and we know that practical use of these transactions is not that much in the market today, but it's still, if anybody feels that they need to make some comment with regard to the effective date, they feel more time is needed on that part, we feel free to comment on that part. I have tried to be a bit quick on the second standard in particular, try to push things forward on a fast pace, just to make sure that we can have some time for question answer in the end. So now, before I hand it over back to Brother Majd for closing, I'll just request if anybody has a comment, question, please feel free. Any comments? Okay, so either it was too complicated or I was too fast. I don't know. But with that, thank you very much for being with us. Thank you for some very, very valuable comments. We believe that some of those comments will be incorporated in the final version of the standard. As you see, inshallah, we are going to take it to the board, and board will take the decision. But I feel that there is merit in some of the case points in particular. So with that, I hand over to Brother Majd for closing.
Thank you, Brother Omar. Valued participants, ladies and gentlemen, dear brothers and sisters, with that, and as we have reached the end of today's public hearing session on the newly issued exposure drafts of financial accounting standards on Istisna and Salam, I would like to thank Mr. Omar Mustafa Ansari, AAOIFI Secretary General, for the insightful and thorough presentation of the exposure drafts and the answers provided to your questions and comments in this session. We would like also to extend our heartfelt thanks to all our valued participants from across the Islamic finance industry and beyond globally for having taken part in today's session on the exposure drafts, and for BILIF Brunei and all regional banking associations that provided their support to this session. As we mentioned earlier, your comments and suggestions are essential for AAOIFI in improving and fine-tuning the exposure drafts for finalization and of the standard, and for final issue of this standard after approval of the board. Thank you again, and see you in upcoming future public hearings on AAOIFI financial accounting standards. Assalamu alaikum wa rahmatullahi wa barakatuh.
Thank you. Salam wa rahmatullah.